Okay, so this video we'll go ahead and actually apply what we've learned with liquidity to a live chart, and we'll just keep using our example of AUD USD that we've been running through for this entire course. And this is the daily chart. And so we're going to be going from this low, which was Thursday, the 14th of July, all the way up to the, currently at the time of filming this course, which is the 28th and 27th of March 2023. So in this zone, we'll just kind of run through really quick and apply these same concepts to a live chart. And so we can see here this daily break of structure. We would expect that at a certain point in time, price would turn around and trade back up into this zone. And at this point in time, all of these little highs, which on lower time frames are more clearly pronounced pullbacks or little bounces off of price action on the daily, these all have stop losses above them. And so when price turns around and comes back up, it's raiding all of this liquidity here and taking out all of the sellers that for whatever reason got in to go lower here, and buying back up, it's taking out all of those stop losses. And as price is coming back up, there's going to be naturally people coming in and placing their stop losses under each of these little lows, and at which point in time price then usually very violently retraces back and reverses the trend and comes back down, and then takes out all these stop losses that are underneath all these lows on lower time frames and clears all that liquidity out. And that's why we get such violently huge moves when we align back with pro trend moves, is because there's nothing arguing against that move. It's all stop losses and there's no resistance. And I don't mean resistance like the patterns. I mean resistance in terms of people buying against the direction that smart money is moving. And so we get this break of structure, and price at that point in time is expected to eventually trade back into that zone, which it does. Creates a very huge swing structure. And throughout this move down, we then have, for whatever reason, traders coming in, whether they entered up here and they're still holding, or they are trading the daily chart, and for whatever reason, their indicators or strategies say to place their stop loss above highs like this and highs here. Basically, each one of these candles essentially has a stop loss above it because of lower time frames and the way that price action reacts on lower time frames. Smart money then comes back in and starts aggressively buying, and they take out all of those stop losses, and then they get people in long here, at which point in time they wick this high. So there was obviously a huge amount of liquidity behind this high and a lot of stop losses. And when it does trade above that, take those stop losses and close open orders in this supply zone, we can then see a very violent sell-off, and it's taking stop losses here. And as we work our way down, it's taking all the liquidity and the stop losses below these lows on the way down. And eventually, the expectation is that it should trade into this low down here. So if you're watching this in the future, I think it's going to be funny as people come into this course and see how accurate I am with this prediction, with this estimate. And hopefully, as people watch this low does actually get taken, at which point in time there should be a very large amount of liquidity behind this, because there's going to be people who say, okay, I want to buy this, what they think is a pullback, to take that higher, and they're going to put their stop loss back there, not to mention the fact that people who were down here and for whatever reason they have their stop loss, as well as breakout traders who try to take those trades lower. Okay, and so that's one thing that I guess I didn't really go into a whole lot in depth, but there's going to be people who have pending orders down here that as soon as this trade does break out, a lot of the times what you'll see is like this, for example, like this wick. This wick does trade a few pips. I can't see that being a lot, but it does trade 5 pips below. Oh, wait, it's actually not even marked right. So it does trade, about 10 pips below this low. And so this, if people have pending orders here trying to catch the breakout of this trade or of this low, that would then, trigger their sell limit orders and then trade back up, and it would likely stop them out, because, if you get the 10 pip move down and then that trade goes against you, 60 pips to this high right here, obviously you're not going to hold that very long and you're going to close that trade. Ideally, a smarter breakout trader would place their stop loss up here, but that's just the way it goes, is that people are going to get tricked in and it's going to go way against them and then they're going to close it, and simultaneously smart money is mitigating this supply zone and taking it lower. And so yeah, that's basically how liquidity works. It's not any more complicated than that, and it doesn't need to be any more complicated than what we've talked about so far. So hopefully that makes sense, and we'll see you in the next section of the course.